All right, everyone, I'm here with Chris Whalen, CPA from the state of New Jersey. Links in the description, by the way, before anyone asks, to his personal website as well as to his Twitter page. You should check those out. He sporadically weighs in on political topics, mostly from the economic angle. And Chris, thank you for joining me.
Thanks for having me, Sticks.
Now, first, because we're going to be talking about Trump's tax plan, this has to be gotten out of the way first and foremost. To anyone who would say, you're on the right, you're on the left, you have some political axe to grind and talking about this, especially on a channel like mine where I do a lot of political analysis. What would you say to them, clear that up first and foremost? And also, if you could introduce yourself, tell people sort of, your economic meanderings, so to speak.
Chris Whalen, CPA. I have a full-service CPA firm here in New Jersey, servicing the whole country. Income tax preparation, income tax planning, a lot of cryptocurrency work that we're doing now. And to get to your question, the tax laws are the tax laws. We know what's been passed, so we don't have to guess. It's really not a partisan issue. I deal in exact science here. We know how to apply the law to fact patterns, and that's what we've been doing since it's passed. So it really can't be, from my point of view, I'm hired to give people a real result based on the facts. It's really not a Republican or Democratic issue.
So when Nancy Pelosi comes by to troll, we can tell her, hey, you need to calm down. Now, you actually, I believe, had some graphics. If you'd like to go through and explain those, explain the rudimentary basics of how Trump's tax plan is going to affect, especially people who make what we would consider average incomes. People who aren't, they're multimillionaires and they didn't make zero. They're from the working class, the middle class, maybe the upper middle class, average Americans. That form the bulk of people who have been abused over time, I think, honestly, by everybody within DC. It's really, as you said, nonpartisan in that respect.
Well, the first thing is, in all the case studies we've done and even tax returns, I'm not seeing the vast majority of people, especially lower income, are definitely saving money, and they're going to have more after-tax income in 2018. So that's really the truth, and we've looked at a myriad of different types of scenarios. So you want me to pull up that first slide?
Sure.
All right, great.
You'll have to explain it in depth for me because I don't know these things.
So hopefully my slide's coming through. So
I think people can see it, yes.
Okay, great. This is a case study I've done, a very common client of mine. And this is a family, they make $100,000, a married couple, family of four, as we see in the top. And what they were renting in 2017. A lot of people are renters around the country. And I wanted to show them two things. Number one, I want to show them, in 2018, if they stayed renting with the same fact pattern, what would the tax code mean for them? I also wanted to show that same family, if they bought a house with some common itemized deductions, what would it mean for them there? So let's just take a look at the first column, and we have $100,000 of wages, as I said. Now, if you look, there's no itemized deductions because they don't own a home yet, but they get what's called a standard deduction, and that's down there at $12,700 in red. They also get what's called a personal exemption for four people with total $16,200. So those two are deducted from your gross income of $100,000, and that gives us taxable income of the $71,100. Very straightforward math, and that gives us a tax of $9,736. So is that clear so far? Am I going too fast?
No, that's all good for me.
All right, great. So now they have two children, and they make they make under $110,000. So you'll see they also get a child tax credit of $1,000 per child, or $2,000. That brings their net tax to $7,736. So that's a pretty straightforward return. A lot of people out there who do their own returns will see this is, it'll be pretty understandable to them. So now let's take the same family in 2018. So this is post-Trump tax plan tax changes. And we have the same income, no itemized deductions. And if we look, they have a standard deduction now of $24,000. So what happened here is that within the law, that a couple that didn't itemize could now take a $24,000 standard deduction off their income, up from $12,700, which was almost doubling, as you can see. But they took away the personal exemptions of $16,200 for this family of four. So that's a negative. So overall, they actually lost there a little bit. So if we look now, our taxable income in 2018 is actually higher. It's $76,000 versus $71,100. So that would seem like a disaster or a problem or what everyone's been worried about. But if we look now at the tax, what is really happening? Their tax is actually almost $1,000 lower. So even though their taxable income has gone up a little bit, their tax is actually $1,000 lower. So even without children, in my example, they still are $1,000 better off. They didn't even buy a house. They are now still renting, but they're having more after-tax income. But it gets even better because there's still a child tax credit in 2018, but the Trump plan doubles that for eligible children. So that now is $4,000. It brings their net tax to $4,739. So if you look in my example in the middle column, they're actually saving close to $3,000 with 2 children, which, looking at their net tax of $7,736, the percentage saved is a tremendous amount of money. Is that good so far?
Yep. Trust me, if I can follow it, everyone else can, because I'm
right,
the dumbest when it comes to math.
I just know it's a lot to take in, but so now we have the third column, which is still 2018, but now this same family with the same income has purchased a home. Now they get to take certain deductions they didn't get to take before. They're called itemized deductions. So we see now we have state taxes we're taking and property taxes, mortgage interest, and some charity. So now we have itemized deductions of $26,500. Now, in the law, you can either take your standard deduction if it's higher or your itemized. In this case, we would take the itemized, and the $26,500 instead of the $24,000. So that gives us a taxable income now of $73,500. It's still higher than it was in 2017. But look, our taxes, of course, are lower. Our taxes are now $1,300 lower. It's even better for them in this instance to buy a home because they're going to save $1,300, $300 more than renting. Of course, they still get their child tax credit of $4,000. So in this scenario, they're saving about $3,300 a year if they buy. So in either scenario with this family, very common, they're still saving money, with or without children. That's why I broke it out by tax as well as net tax after child tax credit.
So Trump has not screwed this poor family and is actually giving them money because they have children.
Right. And yes, very much so. There's a benefit for having children, many of them. If they're under 17 and your income, let me go over the child tax credit. The reason why it's better, and in my next case study, I'll show this. What happened with child tax credit in the past is that there was a limit you could make an income to get child tax credit. So let's say a couple could make $110,000 together, and that was it. And if you made more than that, I'm simplifying, you could not get a child tax credit. So now, but what Trump did is to really help the middle class, he made that $400,000. So imagine the number of families now with children who never got a child tax credit or have much more latitude to make money up to $400,000. You're going to have millions of more people, up a couple 100,000 or millions, that are now going to get a child tax credit that they never got before. And that's in my next example that comes out.
And we'll see that in a moment. So generally speaking, things have been bumped upward. Is this due to the fact that people, whether due to inflation or rising wages, whatever it may be, generally make more than they did, years and years ago under the older tax plans? Is that the inference that's why Trump would do such a thing, because the actual amount has adjusted over time?
Well, of course, and we'll get into AMT in a few minutes. Exactly. So you've had this $110,000 level for a long, long time with that, and people are making more money. So less and less people are getting the child tax credit. So yes, exactly. It's that, of course, limits or floors have to be adjusted for cost of living and average increase in wages and salaries.
And Jal in chat is actually asking about salt. Now, I believe that is mentioned in your next graphic.
Yes, it is.
Yes. Well, then go forth with it.
All right.
We'll answer his question.
All right. So can you see that clearly?
Yep.
Okay, this is very similar to the last slide, and this is going to get into the SALT deductions, which the state and local tax deductions are limited in a sense. And let me just give the general rule. that the combination or total of state and local and property taxes cannot exceed $10,000 now. And this has been a source of such hysteria. And a lot of media outlets, to be honest, have just focused on that one aspect and said, yes, if we're limiting a deduction, is that going to increase your tax? Well, in a vacuum, yes, but there's so many aspects to the tax laws that are really benefiting on the tax rate side and the tax tier side that it offsets that greatly in many respects. So let's get to this case study. We have a married couple with 2 children again. They're making $230,000 in this example. Now they're going to itemize. They own a home. So let's take a look at those slowly. We have state taxes of $9,000. That would be taxes paid to a high tax state, New York, California, New Jersey. So that's $9,000. We have property taxes paid on their home of $9,200. Mortgage interest simply $13,000. Charity of $2,000. So that gives us our itemized deductions of $33,200. Now, the personal exemptions, which are still in force in 2017 per person in the family, is $16,200. We get to take that off taxable income in 2017. So we have taxable income of $180,600. Very simple math. Now that gives us a tax of $37,453. That's an exact number, as we talked about at the opening. This is a nonpartisan number. This is based on the actual law. So we have $37,453. Now, I want you to notice that there is no child tax credit for them because they made too much money. We just mentioned that a minute ago. They made more than the $110,000. They never have seen a child tax credit. So now let's go to our second column, which is the 2018. We're applying the new law with all its limitations to the same fact pattern. So we have $230,000 in wages. We have state taxes. Now, please note the state taxes and property taxes are maxed at $5,000 each, right? So we're losing $4,000 of state tax deductions, $4,200 of property tax deductions. We still, the mortgage interest should be $13,000 there, and it comes down to itemized deductions, say, of $28,000. So we have here taxable income of $202,000. Our income tax is now $37,058. Okay, so the savings there is $395. The idea here is to show they have about $20,000 increase in taxable income. Look at the $202,000 versus the $180,000. But that would seem, again, hysterical. Oh my God, there's no way that we're going to be okay with taxes. But this is close to a break even. And part of that is because the AMT, the alternative minimum tax, was finally adjusted up. And I don't want to get too complicated, but let's suffice it to say that 95% of my taxpayers, my clients that were in AMT, are no longer going to be in AMT. And that's an alternative tax that's punitive, that actually increased your tax over normal tax. And so for this family, it's gone. So even though they have higher taxable income, they still are a break even or even benefiting slightly. I consider this a break even. So this is very common across the board that you're losing some itemized deductions, but the AMT has changed. Your tax rates have gone down. Your tax tiers have moved up. So now let's continue down. Now this family, if they have a child or two, they are now underneath the threshold for child tax credit of $400,000. So they're going to get $4,000 of child tax credits. So now a break even becomes a $4,000 approximate tax benefit for them. Even if it was one child, it'd be a $2,000 tax benefit. So again, we need to look at your projection as a whole, because the SALT deductions are only one very small part of the changes that were made. They took away something, but they really accommodated it a lot in the rates and the AMT and the tax tiers.
Yeah. See, speaking as someone who now is making more money than in the past, you look even online, and perhaps you can address this. You look on the internet and you try to Google, how much tax might I owe? And you get these weird draconian situations where you might owe 30, 40%. And it seems like generally, according to what you're saying here, it's actually considerably less. I think some people don't quite understand, maybe first-time taxpayers, people who maybe they've moved up an income level or so. What would you do to sort of take care of their fears of being totally screwed, maybe depending on their situation?
Well, again, I do varied tax returns here. I've probably filed 80 or 90 individual returns already this year, and that was only since the e-file came online January 29th. And honestly, I am analyzing, as I said at the beginning, I'm analyzing what does the new code do for these taxpayers, just as in my case studies I just showed you. So 95% of the time, there is no negative tax consequence to the law. And so it's really good because it's random, right? I have some people making 50,000, some have businesses, some are making $500,000, some have no itemized deduction. So I can't see many situations where there's a negative tax consequence. I see some break even. There are some that pay a little more tax, but it's very small, relatively speaking. Like, for example, if your tax bill was $15,000 last year, hypothetically, it's rare that's going to become 20,000. Let's say it's rare you're going to have like a 30%. It's not working that way. And just to explain, can I explain how the tax system works a little bit?
Sure.
Okay, so just to make it simple, everyone starts out at zero tax. And as you make more money, that you go into different brackets, they're called. So you could go 0%, then the next 30,000 could be at 15%, right? And as you make more money, you get in 2017 to a max of 39.6%. So just imagine that all of those 7 or 8 brackets, let's say, make it simple, that they've taken those rates, those percentages, and lowered each of them. So just say they did that. So think about it, that if your income was exactly the same, right, we're going to pay lower tax, right? Because within each bracket, 1 through 7,
Yeah.
Also, they've taken where those brackets start. So when I go to the next level of tax, right, when you go to the next level of tax, it takes you longer to get there for the income sometimes. So there's two positives. The percentages have gone down on average for the brackets, and they've moved the brackets of when you enter them with that portion of taxable income. I don't want to make it too complicated, but that's part of why we see in the last. Plus, they've eliminated AMT. So the last example was a good example of exactly what I'm just describing.
See, I have no clue what AMT actually refers to. What specifically does it mean? Alternative minimum tax. I've heard that term before. What does that actually mean?
So this is important. So they made alternative minimum tax, and let's say 50 years ago, let's say 1970, they made this it's for rich people to pay more tax than everyone else. That's what it's there for. And what alternative minimum tax does, it says people making over a certain amount of money, they start to lose the benefit of their itemized deductions, right? So it's what everyone would want. Okay, if you're making a lot of money, we shouldn't get the same property tax deduction, right? We should lose that, or we should lose our exemption. So the limit was about 250,000, let's say hypothetically. That was in 1970 when that was a millionaire compared to today. So the problem is they, just like with the child tax credit income, they never increased it. So for 50 years, our incomes have gone up. So now more and more people are making that average money, let's say, but they're getting caught in paying this tax that was meant for more wealthy people. And
that's actually strange, because I remember the left for years now has said wages haven't kept up with the times, so those need to be increased. So then why would they be against Trump's tax proposal? That's actually an interesting point to make. So and also, what would be your thoughts on a flat tax as well? Because I know throughout time, some people are talking about this in chat. People have said, hey, what if we just had one low, very flat tax with a very small number of actual deductions or anything that could be done that people could actually pay? What would be your thoughts as someone who's more of an expert on this sort of matter? What would that do maybe to the economy, or at least to people's lives, to their well-being?
Well, if a flat tax, that's truly a flat tax, meaning it's paid like a national sales tax, hypothetically, right? So we eliminate the Form 10, we eliminate tax returns completely. Well, to me, that would be more fair. But the problem is that you have to adjust out for people that don't make a lot of money. Like right now, we have, say, 47% of the country is not paying income tax at all. So let's say we did that, we made it 10%. Well, you suddenly have, if it's a national sales tax, we suddenly have people that don't pay any tax that are going to be losing 10% from whatever they purchase, right? So we got to be careful there. But if you're going to have an adjustment or an exemption, then you have to do a tax return. So I'm still needed, right? The idea, if it's a flat tax, you got to get rid of me, right? You understand? So naturally, you wouldn't want that. Well,
Problematic.
I do so much business work that to me, it wouldn't matter if it's a flat tax or not. You know, for my practice, I'm doing business consulting. And so the tax return is done, but even if it's a flat tax or not, we still got to account for the business income. So it wouldn't hurt me as much as, say, a fast food type tax preparer that has a shingle out on his house. Right?
Now, just as a question here, and this is more humorous. This has nothing to do with the tax code. And you can go more into the numbers in a moment if you want to, if you have other graphics or anything as well. Have you ever had a time where you've run a projection for someone? Obviously, you can't use names for legal purposes, right? But you've run a projection, you filed someone's taxes, whatever, and they just completely flip out because they don't want to pay the money and they blame you for it, or they go crazy and do crazy things. That would be something I would love to hear about that.
I have had tax client stalkers. That's what, to be honest with you. Well, I think this goes back to the fallacy that the refund you get shows how good a tax preparer is or not when it has nothing to do with it. It's the net tax. So yes, oh no, I could tell you, believe me, we could be here for another 3 hours of people who are unrealistic. They're filing late, and they have an idea. I got an email today. Someone said, I think that my Jersey refund should be higher. And I wrote back, can you tell me why? Right? They just have an idea because they're getting advice from Susan at work or Bill, or the worst thing, they're getting their advice from the Today Show. I tell everyone, listen, the moment you tell me that Coda and Kathy Lee are giving you tax advice, you're not my client anymore. But yes, I've had people are in denial about especially self-employment tax. People don't realize when they're in business for the first time, they got to pay ordinary tax, but also self-employment tax, which you and I have talked about before.
Yes.
Which can be hefty. I know I've had people cry. I've had people get weak in the knees and fall back into their chair.
But have you also had people that are like really, really happy because they thought that they would pay way more, and they're like, oh, thank goodness, they just like faint anyway, or they go skipping down the road or some crazy thing like that?
I get the hugs across the desk. I get edible arrangements coming to my office. So yeah, you would think it's like I'm being courted. So I get, the main thing is people have all this worry, and sometimes it's not even the number. Like I said before, I'm exact what I do. So I can say, listen, your tax is $22,005. Oh, good. They know what it is. Now we can address it. People have this specter. Well, it's a combination of unknown, but the IRS gets them scared. So when you combine something you're afraid of and unknown, people have anxiety. My main job is more like emergency room intake. They're like, please take care of this. Please let me know it's okay. So that's my job all days. It's going to be okay. Let me take a look and I'll tell you. I'll give you a diagnosis.
So everything is absolutely exact within the numbers, and people are not being screwed over. But with one exception, do you remember the episode during the Obama administration when I believe it was Lois Lerner and the IRS were targeting certain groups?
Yes.
They were applying for nonprofit status. What happened at the time? Like as a CPA, I think at the time you were. What were your thoughts then? Did you believe the explanation that was given by them? Not to go into partisan land, but in general.
Well, I knew of examples because I do a lot of nonprofit work. So I was actually contacted by people who I do a lot of applications for 501c3 status. I help clients with that. So there's no doubt for those kind of groups that I was working with, or they were calling me because they had that the level of time, it does take them a long time to approve. Remember, you can put an application for nonprofit status and it could take you 6 months. But some of these groups I was dealing with, just based on facts, were definitely not being answered in the same amount of time or answered at all. So yes, so from my perspective, I saw a delay for some reason with these specific groups getting an answer to their application.
So even you as brick and mortar, you even saw an effect from that at the time yourself?
Sure.
With people you were working with directly?
Yeah, well, and people who would, so exposed on the internet, so people would, they might have a preparer, but there were some people that reached out to me and said, hey, Chris, in your experience, just how long do these things take? They were just getting like a second opinion about, and I told them, hey, listen, between 6 and 8 months, and it wasn't, yes, there are some types of groups that usually take longer, but for a political action kind of group, right? So I did notice that it was longer. So some of them seem longer than average. And I can't attest to exactly which ones, but there seemed to be some delay I was seeing.
Yeah. Now, another thing, people are talking about property tax in the chat. Now, I've always held that property tax invalidates capitalism by turning ownership into rent of
Right.
the ability to produce things. I don't know if you have any particular strong feelings on that. What are your thoughts on the actual use of a property tax by a state in terms of either commercial/industrial property or just a person's primary residence, their actual home?
Well, a few ideas about property tax. Number one, that there is no private property, right? So as we would imagine it, right, constitutionally, right? So, I'm renting in a sense. If I don't pay my taxes, I can lose that property pretty easily. So the idea that you do own it is really only subject to you paying someone else. So that sounds like rent to me, or leasing. That's the first thing. The second thing, property taxes are really, I don't think, calculated correctly. So, right, property taxes work where I have a certain assessed value in my town for what's a building square footage and land. So, $1 per square foot, whatever, for building. But what happens is, if you have a bigger home with more land, of course you're going to pay more money. So it doesn't mean you're using more services, right? Think about it. So if I have twice the house and twice the land, and you have 6 children, I have none, I'm paying twice the property taxes for the schools here, so of course we need to pay for schools. So that's why I usually think property tax would be based on how many people live there. The fact that I have an acre of land doesn't mean that I should be paying more for the fire department than you are, paying more for police. So there's 2 aspects to it that I know they're doing the best they can, but again, it's not private property. You're not. I think that it should be turned into a occupancy tax of some kind. Then you could be evicted. I'm not sure, but that's my thought about it. It's not fair because you own a bigger house that you're paying more tax because you're not necessarily using more services in the town. Does that make sense?
Yeah. So perhaps in a roundabout way, you're actually against one proposal that Trump is putting forward in the tax plan, because under his tax plan, wouldn't some hyper-religious family with 15 kids get an enormous tax break on child credit, as opposed to maybe the property tax angle where they're actually deducting less? For maybe the next door neighbors, they have 1 kid and they get less of a break and actually end up paying a hell of a lot more because they don't have a bunch of children.
Yes. This is although I would rather lose some of my property tax. The more children I have, I like this plan a lot more, because don't forget, I'm losing a deduction in the property tax, let's say, but then I'm only losing the tax benefit of that, right? So I'm in a 20% bracket. I lose 10,000. I'm only losing 2,000. If I have 3 children that are eligible, I'm getting 6,000 real dollars. Remember, it's not a tax deduction. It's a credit. So the more children you have, it's easy to, that's why you got to look at the whole law. Like you saw my examples, people with families could break even for tax, but now, the child tax credit is going to be. So yes, it benefits. Give me those 15 children. In your example, wouldn't
it be interesting if this actually contributes to a baby boom of sorts, because of the way the tax code is working? Is there any cutoff? Like, is there any number of children that provides an absolute concrete cutoff? Like, hey, above 10 kids, we no longer give you the credit.
I haven't read that yet. They haven't really promulgated the full IRS code yet, so I don't want to answer that yet. But I haven't seen that yet. But I'm sure they're going to they might limit it to 10. I'm not sure, but for
biochemical purposes.
Yeah, that's right. But it definitely benefits people having children.
Yeah. See, now is the code finalized? Like, is it absolutely lock, stock, and barrel? It's complete and it just hasn't taken effect or been published yet? Or is it still malleable? Are they still debating over what it actually will end up containing?
I think everything's subject to change. I mean, I have not seen the code, the fully written code, where they would send out the new Internal Revenue Code. So I don't anticipate a lot of changes based on, what the law is. Anything could happen. Anything could happen. I mean, I think the biggest things they pushed through, even though the blue states didn't like it, was this limit, and I think that's staying. So I think if that's staying, if that's the biggest thing, and no one could fight that off, I don't think there's going to be a lot of other changes. I mean, don't forget, they're already changing. We'll talk about in a minute. The payroll tax tables have already changed, so that everyone should be seeing an increase in their paychecks. We talked about that. I want everyone to be careful, though, that please have your tax preparer check if it's adequate. Sometimes people are getting increased paychecks right now, which is good because the law changed. But they're not having enough withheld. So you got to make sure that it's going to be adequate for this year. As you don't want to be surprised in January that this windfall you're getting every pay period is really going to leave you owing, right?
Yeah. Now let me ask you one thing before you get into, I believe, other graphics. What is, in your opinion, as a CPA, what's the worst element of the U.S. tax code, maybe as it was and or as it would be under the new Trump tax code, either one or both, to tell the truth?
Well, you mean from an individual or corporate perspective? Either one?
Well, individual, because most people file as individuals, not as corporations.
Well,
for the average American, what would be the most onerous, burdensome, tyrannical, crazy aspect of the whole tax code?
Well, a big one is the earned income tax credit, right? Earned income tax credit is supposed to help lower income people, especially with children, to get some tax credits separate from child tax credit. And it's one of the hardest things to do. So you have people who are lower income that don't have the money to pay someone like me, but in order to get it done, they have to use somebody like me, because there's so many due diligence things. It's onerous that way. You have sometimes some of your contributions, the non-cash contributions. People give a lot of things away, and so the limit right now there's $500 you can say on your tax return is non-cash. If you go above $500 of value, you have to fill out, I gave it to the Salvation Army, this is when I bought it. So that's another limit that should be increased, that we could say, listen, I gave $2,000 of clothes and old furniture and books, to the thrift store without having to go through, it takes me time to do it. So again, it would make more giving if people had a higher threshold for reporting. 500 is too low. Today, in today's day and age, that hasn't been increased in years too. So a person can claim that $500 without having to actually document it as well. Right. But above that, they have to itemize it all. Right. They have to have a receipt from, say, Salvation Army, their address, the ID number, what you gave. It's a cumbersome form. And also for charity, people think they have to have a receipt for everything. That's been out there in the news for a few years, but you can't get a receipt. So I urge everyone to keep track of your giving. Like, for example, when you go past the Salvation Army bucket at Christmas, I can't get a receipt for that. But during the year, there's a couple of $100 you might be putting into a 7-Eleven, a charity, bin, a McDonald's drive-through. So keep track of it, because, it's not, you should take it if you gave. Even this, you can't get a receipt all the time. Just keep track of where the money went. And that's 100% deductible if you itemize. There's no limit still, well, up to 50% of your income. But normally someone makes if I have $2,000 of giving I'm taking now, that's $600 real of tax savings for some people. I see that a lot. I see, I don't have a receipt. Well, again, you heard me, we can't get one. So that's a really good advice to people. Also, one other thing about medical that's important is that they lowered the floor for medical, say 7.5% of adjusted gross income. So you still should keep track of your medical. Again, I have a really good blog post on my website. If you go to my memos page and search for medical, there's a lot of things you can take for medical that people don't realize. Okay, if you get a doctor's note for certain things, like such as a mattress and things like that. So they should really get to know it's not that hard to get above 7.5% of your adjusted gross income, especially for someone making $50,000 if you itemize, you see. So that's something that helps people save money, just coming to a professional like me.
And just so you know, there are almost 1,000 people watching us live right now, but you're being asked by a lot of people about your opinion of the death tax. Before you get into your final graph, I promise I'll let you get into that after
I know it's
this.
Okay. Well, my feeling about a death tax is that it is, it's taxing something again, right? I have an estate of $5 million, and I've already paid all my taxes on that. And so I should be able to transfer that to whomever I want, especially children, or say I pass away, it's my wife, without paying another tax. But I do agree that the idea of the death tax is that, well, we've accumulated this wealth, and although we've paid tax, we should give something back. But the rates, of course, to me were much too high. So the reason why the death tax hurts is that let's say you have a small business, a small contracting company. It doesn't take long to get up to a couple of $1 million in value. So I want to give that to my children. And sometimes you're forced to divest it because you have to pay estate tax on it at a very high rate. So I think for that case that it's again, we should make enough money in income taxes that we shouldn't have to double tax anybody anytime, including upon their death. So I think it's unfair to double tax anybody anytime.
That would make sense. It's kind of like a sales tax on goods that have already been taxed at the manufacturing level. Let me just say, by the way, for the benefit of people in chat, I would love to figure out exactly how much money you'd have to make to have a 10.2% tax. But I believe you had an image or several images to show as well, other tax scenarios potentially.
Sure. Here's a good example. I have someone making even. Hold on a second. All right, let me just share my screen.
Someone saying repo will be coming for your ass in the afterlife. The government works the same way there. Yeah, absolutely.
All right, so you have my case study number 3 on the screen?
Yes.
So this shows a good
No, this is case study number 2, but it's the third one you've shown.
Right. So this is a family making $500,000. So this is a good example of people, wow, I'm making some decent money and I'm going to lose my item. So let's just take a look. I'm not going to take too much time, but look at their state taxes and property taxes are a total of $45,000. Now, this couple is losing, look, they're losing $20,000 of their state taxes and $15,000 of the property taxes. So they're losing $35,000 of their itemized. Now, they don't get a personal exemption in 2017 because that was phased out because of income, so that's not an issue. And look, our taxable income is $35,000 higher, but still our tax is lower. So we have, again, this couple, and I push this a little bit just for example, but again, look at, we're losing almost half of our itemized deductions, and we still can be at a break even or even a benefit. And that starts to go down, though, as you make more money. But this is a good example for anyone out there who's a God, I have really high property and state taxes. Well, it might not be that bad. Have it analyzed. Again, we don't have to guess. We don't have to stay up at night and worry. We simply need to call a tax professional and say, oh, analyze this for me. Let me know how does it impact me, especially, and I'm going to turn off the sharing here. If,
some people are saying, oh, an average family doesn't make $500,000 a year, but you're in New Jersey, though. Are you in an urban zone?
Yeah,
that's probably
I'm in a suburban zone, but I'm in a high net worth zone. So, but everyone is concerned, and I have clients of all over the strata, so we have to accommodate them too. They also have nerves.
Oh, definitely. Yeah. Here, if you make $500,000 a year, it's quite something. It's small town America, to tell the truth.
But I think the takeaway is especially about, let's say, people that don't own a home yet, but they're thinking of buying out. So it's very important that I get the question every day, well, I was thinking of buying a house, but now I hear that the benefits of buying a house are gone, right? Because in a high tax state, the property tax will be limited for me. So is it really worth it? Well, first of all, you buy a house for a lot more reasons than the tax deduction, number one. But I think that my examples, and of course, they're only examples, will show we need to look at the whole tax structure right now to see what is your net after-tax income. Like, for example, if you look at the first example with the renters, well, they would save, up to $1,300 even without children. So we see that they're not losing money, that their ability to buy a house is at least equal of what it was before the plan change. That's what we're seeing. So we should look at the net after-tax income of the whole plan applied to your situation, including the SALT limitations, to see what is my net after-tax income, because we've taken away the deduction sometimes, but we've given a lot back in rate and losing AMT, like we talked about before.
Now, there's before I let you go here, there's one more important thing, and this is something that I heard echoed by the media over and over and over again. And I caught on to it and a few others did, but a lot of people didn't. Just to make sure everybody out there knows, as you explained to me before we went live here, the difference between absolute numbers and ratios when you're talking about how much is actually saved, because what's been pointed out is a rich person saves more as an absolute number, but the actual ratio to the income is considerably lower, whereas people at the lower end of the spectrum of income, maybe working class, lower middle class, as a ratio of what they would normally owe, have saved a lot more.
Right. So I'm going to pull up another slide if you give me a moment.
Okay.
This is a good example, and I'm doing this for $1 million family because I want you to look down at the bottom. I did this just for this question in case it came up. Now they're saving a little bit of money. They are, but that's what I'm looking at here because it goes to your question. So they're saving 3% of their tax. So they're saving $8,500. Now, if we go back and we look at our examples earlier, let's look at our first example, all right? So now they're saving more than twice as much as this couple, right? Think about it. They're saving over $8,000, but this couple's only saving $3,200. But as it relates to their income, right? Not 3%, they're saving $3,297 from $7,736. So they're saving 43% with those children, right? Even without the children, they're saving $84.39 against $97.36. So they're saving 13.3%. So we see that, yes, the higher income person, the $1 million earners, save technically more absolute dollars, as you said, but the percentage of their total tax is much lower. This example, right? That's what you were talking about.
Yes.
So that happens as you get higher. The percentage of tax saved as a ratio of total tax is much lower as you get higher, usually.
And then there was one final thing that I believe you wanted to bring this up as well. Your thoughts on the future potentially of cryptocurrency, because I know you get involved with that to some degree.
Yes.
If you could explain to people in brief what you do with it and also your thoughts on crypto in general, because literally everybody is talking about it these days.
Well, first, I don't see a big difference between our US dollar and a cryptocurrency. They're really backed by nothing but faith, right? So it's very similar to me. First of all, I want to explain about crypto is that people don't understand how you're supposed to account for crypto. So when you have a cryptocurrency like a Bitcoin, let's say you hold it and it goes to $10,000 in value, that's not taxable. But if I exchange that for 10,000 of Ethereum, let's say, that is a taxable transaction. It's not just when you get cash. So you're having people that are almost day trading crypto. So I'm seeing spreadsheets with 30,000 lines. So remember, every time you exchange it for something else, it could be a gain or a loss, right? You have to account for that transaction. So again, if it's short term, it's ordinary income to you. So you have to make sure that, and there are people are getting a form like from Coinbase, for example, they're going to get a form 1099K. It's a form that's going to show you, how much you've traded for the year. It doesn't mean your gain. It just shows every time you exchanged, either for cash or another crypto. So people are getting these statements that have $10 million on them. I'm like, no, that's not. No, we have to do they could have a loss. So the most important thing is to keep track of every transaction that you're exchanging, because we're going to need to account for that at tax time. And we do a lot of that here. We do a lot of analysis here for crypto, and a lot of accounts aren't up to speed on it yet, and I'm sure they will be. But the government is looking at it. I know everyone's all afraid of the government, but it is income to you in some way. It's as if we traded stocks. Same thing. It works the same way. If you know how I'm exchanging a stock for a stock, well, if I exchanged Apple Computer for IBM, that's a taxable transaction to me. And so you need to account for it, not just when you sell it for cash.
And so there you have it, folks. This has been Chris Whalen, CPA. I enjoyed talking to you, by the way. It was illuminating.
Thank you, Sticks.
And was there anything else that you wanted to say in closing?
No, just again, I just want everyone to make sure two things when they get their taxes done, that they are provided with a projection for 2018 to make sure that they see what the impact is so they can properly plan. And no, just it's the middle of tax season, but I appreciate everyone listening, and I hope everyone got something out of it. And please, if you have a question, go to my website. There's a contact page there. Send me any tax question. I'll try to get back to you as soon as I can.
All right, and there we go. Thank you for being aboard.
Thank you, Sticks.
Bye.